Okay, for your assignment in Unit 3, Section 4, called Transaction Clarification, here's how you would go through Part 1. So we're looking at a fees account and revenue and expenses, okay? And then we're going to put the net balance there at the end. All right, we're looking at St. John Paul College of Engineering, and we received the following fees from students. Okay, so we received these, so that'd be revenue for us from students. Okay, we received tuition fees, library fees, and other special fees. So, and then the college paid $2,000 in examination fees to Chicago University. Okay, so that's money that left us. Okay, we paid that. So we need to prepare the fees account for the college. So when we're looking at revenue, and if you have read the material, you know that revenue increases on the credit side of an account. Okay, so we're looking at this as a revenue account. Fees is, I know this probably makes you think fees that we've paid, but this is fees that we've brought in. Okay, and then we also have fees that we paid out in examination fees. So with a revenue account, this is set up a lot like a liability and owner's equity account with our debit side. Let's just go ahead. I like to just have my, I like to just put in my debits and credits so I know what I'm working with. So this is like a liability account or owner's equity. Actually, it's more like an owner's equity account where our debit side's our decrease side and our credit side is our increase side. And I just like to do a little bit of this. Okay, so now I know which side's my increase and which side's my decrease. So with my tuition fees, that's money we've collected, so that's going to go on my increase side or my credit side. Okay, same with library fees, we got $500 there, and other special fees, we got $1,000 there. So then I have to look at my examination fees that we paid out, so that we're paying those out, so that's going to go on my debit side, and that's $2,000. So then we want to record the net balance of this account. And so since this is a revenue account, our normal balance is going to be recorded on the credit side. So how we figure the balance is we add up all of the transactions that increase this amount, and then we subtract the transaction that decrease this amount. So I have 10,000, 10,500, 11,500 on this side, minus 2,000. Okay, so that gives me a net balance of 9,500. That's part 1. Again, we're skipping part 2. This time is also because it wasn't set up quite right in your assignment. So then in part 3, now we're talking about a lot like the previous assignment where we see a transaction and then we have to determine the accounts that are affected. Okay, we don't have to deal with the amounts. We're just looking at the accounts. All right. So John David invested $50,000 in his business. Okay, so this is that very initial transaction where a business starts. So he invested $5,000, so that's going to increase our cash, and it's also going to increase our owner's equity. And we always have a debit, and then in this case, cash is an asset account, so it increases on the debit side. And owner's equity is an owner's equity account, and it increases on the credit side. Okay, so this next transaction, we're billing a customer for goods that were supplied worth $7,000. Okay, so he's not paying right away, we're billing him. And we are selling $7,000 worth of our goods. So that's going to affect our, which account? If we're selling goods, that's going to affect our sales revenue. And if we're billing them, it says they're not paying us cash, we're billing them, which means they're going to pay at a later date. So that's going to affect our accounts receivable. Okay? And in this case, in this case, so the accounts that's going to be debited are accounts receivable. Well, let's just clarify. Our accounts receivable is an asset account. Okay, it's money that we're going to own, sorry. And sales revenue is a revenue account. And so that means we're going to decrease on the debit, increase on the credit with this side. And with accounts receivable as an asset, we're going to increase on the debit side and decrease on the credit side. So if we're increasing, essentially we're increasing both of these accounts. So the account that will be debited is our accounts receivable. And the account that's credited will be our sales revenue because it increases on the credit side. Okay, so that's how you do that section. You don't have to do anything really with the amounts. You're just telling me what accounts you're working with and how they're affected. Okay, then in part 4, we're just looking at owner's equity. And we are looking at these revenue and expenses that occurred during this specific period. So we need to determine the end balance of the owner's capital account. So with my first, I have sales that happened during the period are $50,000. So that's going to increase because they're sales. We're going to credit $50,000. And the expenses, these are going to essentially decrease our owner's equity account. Our expenses are there should be advertisement salaries. Wait, nope. What about that on the next one? We have salary expenses and advertising expenses. So we have salary expenses there. Then we put in our advertising expenses there. And then there's a couple miscellaneous items. We deposited a check from our owner's personal savings account of $5,000. So it came out of his personal account. So not our business's cash account, our personal account. So that's going to essentially increase our owner's equity. And then Mr. Nichols removed an office computer for his son at the cost of $750. So that's going to ultimately decrease our value. Okay, and then I want you to figure out the balance of the owner's equity account. And since we increase on the credit side, this normal balance is going to be recorded on the credit side. So you're going to add up your increases, subtract your decreases, and find me the balance. Then in part 5, this is a lot like the last assignment. We're just classifying this account and determining which side's the increase side, which side's the decrease side, and which side would be our normal balance. Okay, so one thing I don't want you to get confused on is this company is an airline. Okay, we're working with an airline company. So flying fees is what the customer is paying to us. Okay, these aren't fees that we're paying. This is fees that the customers are paying to us. I know that fees kind of just makes you think that it's stuff that you owe, but in this case, it's being paid to us by the customer. So tell me what type of account that is. And then also with the airline account, this is, I know this kind of account name can be confusing, but this is just another account of what these airlines own. Okay, so that should be a clue. It's the account that value that they own. So what type of account does that make it? Okay, and that's how you do assignment 3.